Welkom, beste kijkers, bij een nieuwe aflevering van de Sofa van Bolero. Vandaag gaan we het hebben over edelmetalen en industriële metalen. En daarvoor hebben we Andrea Gabellone uitgenodigd. Andrea is het hoofd van het Global Equities team van KBC Securities. Welcome, Andrea. Thanks for making time for us today. Andrea, there are different ways of investing in metals. Can you explain a little bit for the viewers which ways there are?
Right, there are two major ways. The first one is getting exposure to the actual commodity, and that can be done via mainly ETFs. That can be physical or synthetic. And the second one is via miners, meaning companies that are engaging in the extraction of these materials from the earth.
Mm-hmm. And why would one choose one over the other? What's the difference there?
Right, so getting exposure to the actual commodity is the pure play on that commodity's macro drivers. Miners add a company-related layer of complexity, of course, which spans from balance sheet risk, operational risk, but also political risk. The key topic here is convexity. So depending on where we are in the cycle of a commodity's demand or supply, it can be more interesting to get exposure to one or the other, meaning the physical commodity versus the miner. Especially early in the cycle, what happens is that for miners, revenues rise faster than costs. And in that way, the companies can nicely expand margins and also generate more cash. That way, it's usually a situation where miners outperform the physical commodity. Later in the cycle, what happens is that the margin expansion is more limited, and especially if the commodity price momentum slows down, well, it's more difficult for miners to outperform. One critical point that I want to outline is that it's therefore, let's say, incorrect or it's a misinterpretation to say that buying a miner is a good proxy for the underlying commodity. That really depends on where we are in the cycle. There are also some ratios that I look at to understand, for example, where we are in the cycle in terms of risk sentiment. Mm-hmm. So the first one is gold to copper ratio. This is a clear defensiveness versus pro-cyclicality indicator. If gold to copper increases, it means that the market is getting more cautious and more defensive, and vice versa. Another one is copper to aluminum ratio. When copper to aluminum increases, it means that there is kind of a more risk-on sentiment, because copper is a proxy for high-value industrial activity, while aluminum reflects the traditional mass industry demand. So our kind of framework to gauge whether it's attractive to go into miners or the physical commodity is, if gold to copper is increasing, we'd rather get less exposure to the high beta miners, so the kind of stocks and risky assets. If copper to aluminum, on the other hand, increases, maybe a more cyclical stance, a more risk-on stance makes sense. But of course, that always depends also on the underlying fundamentals of the miner that we are looking at.
Okay, so I want to go a little bit further into detail on gold, as you mentioned. Gold already had an immense run past year. How do you see it going forward this year?
Yeah, what we've seen actually is that the few dips that have occurred recently were quickly bought, which implies that the underlying demand drivers are still very strong, and the macro ones as well. Regarding the macro drivers, we see that heightened geopolitical risk is still there. There is still, let's say, questions around the Federal Reserve independence. There is still a path for Federal Reserve easing into 2026 and a weak dollar. All these elements are driving demand into gold, and therefore, basically, that's why I think most of the dips have been bought, and the gold has continued to rally even beginning of this year. From the demand side, I further look at three main elements in terms of market participants. The first one is, again, central bank demand, and that has been really strong from all over the world and has continued also this year. Therefore, I think that's a strong tailwind for the gold price. Second, I look at managed money, so basically investors positioning and ETF demand. That has been also increasing dramatically because globally speaking, investors have been getting more exposure to commodities in general. And that's kind of a momentum indicator for us. And third, dealer positioning. Dealers are really those who execute the trades. And what we look at is a buildup of the short positioning, because if short positioning of the dealers increases, it means that they are receiving more long demand, the opposite demand, and means therefore that demand is still there.
However, Andrea, 2025 was a bit of an unusual year for gold as miners outperformed bullion. How do you explain that?
Right, so indeed it's quite of a unique situation because miners outperformed the spot gold. The reason is that miners have proven quite good execution, disciplined capex spending, and also good operational, let's say, execution as well. So what happened is that, as I explained at the beginning, they could benefit from that convex, let's say, convexity and margin expansion, which helped them to really increase their free cash flow generation. Into 2026, I think that fundamentally the positive momentum is still there for miners because upgrades of their free cash flow are still coming up, I think, and also we see that miners are continuing to be disciplined in their operational execution. However, I think we have to distinguish between two types of miners. There are some more leveraged and more risky miners from a balance sheet perspective that have benefited more significantly last year. Like for example, AngloGold. Yeah. In that sense, these companies are more at risk if gold price momentum, and I'm talking about the spot gold, fades a bit. Fade, yeah. Exactly. So in that case, we would prefer more leaner players or companies with a leaner cost structure, like Newmont, for example. So again, it's always in relative terms and relative to where we are in the cycle.
So we've spoken about precious metal like gold. Where do you see industrial metals going for this year? What's your outlook?
Right. So starting with copper, copper is a commodity that is a metal that we favor because we think that both the demand and the supply conditions are positive and supportive of copper. On the demand side, we see further demand for electrification, continued demand from major players at national level, like the US itself with Section 232, but also China, who's increasing the strategic copper reserves. And on the supply side, we see that there are still supply constrained bottlenecks in the supply chain, which therefore should sustain the copper price. On the equity side, the miners have rallied quite significantly, so we would be a bit more cautious there.
Okay, Andrea, so you still see some upsides for copper. How do you see aluminum going forward? How do you frame it against copper?
Right. I think the main driver of aluminum in 26 is going to be on the supply side because China is committed to the aluminum production cap for this year on the one hand. On the other hand, supply remains constrained outside of China as well by bottlenecks linked to energy availability and the infrastructure capacity. Demand also remains strong. For that reason, we think that the metal is well set up into 26, and a good exposure to aluminum from the equity side would be from Norsk Hydro.
Okay, so we spoke already a bit on industrial metals. We touched gold already. There's one specific commodity that has been outperforming really well the past year. What can you tell us about rhodium?
Right, rhodium,
Mm.
a very specialty metal in that case because it is derived, is a byproduct of the production of platinum.
Mhm.
So its primary application is for emission reduction in catalytic converters of internal combustion engine cars.
Mhm.
So let's say the main driver of this commodity are, on the one hand, regulatory aspects related to emission standards,
Mhm.
but also as it's a tight specialty market, any changes in production and for instance recycling volume can highly influence the price movement, and that's why it had quite of a tremendous run last year. But let me say this way, it's a very small and illiquid market compared to other large industrial and precious metals. Therefore it has
So,
much more volatile
volatile
swing.
market, yeah.
Exactly. So I would say it's a very attractive market because it can generate a lot of volatility and therefore let's say profit opportunities as well, but it's on another level than the traditional let's say base metals, for example.
Great. Andrea, you've mentioned the energy transition already and what it does with certain commodities. How do you view uranium and lithium in that story?
Right. So uranium, it's also a commodity where we see a positive trend for 2026. Why? Because last year, especially in Q4, we got positive signals from utility companies. And indeed, they started to be contracting again uranium, so getting long-term contract. Just to give you some reference, the total contracted volume from January 25 till September was 44 million pounds of uranium. And only in Q4, that number jumped to 38 million pounds. So let's say it's been quite of a large uptick there.
Mhm.
And what we see is that this is still below the replacement rate, which implies that in 2026 we should see some further demand. So we are positive on uranium into this year. With regards to lithium, it's a bit of a different setup. So there we are less positive for this year. Why? Because yes, demand remains strong from energy storage systems and generally electrification, as I explained also earlier with regards to other commodities. However, we are in a bit of an oversupplied market still this year, and therefore at the margin, we think the downside risk is higher than the upside risk for lithium.
Andrea, I want to get back to the first question that I've asked you in regards to physical investing in physical or in the miners. When do physical beat the miners in this case for uranium?
Right. So let me start from the miner's perspective. In this case, for uranium, we see that miners usually outperform when contracting activity accelerates. And because of that convexity effect, usually long-dated cash flows are upgraded by the market, which implies that you should see a subsequent stock price performance. On the other hand, for lithium, we see that lithium miners underperform when the market is pricing scarcity, but when the focus is more on the execution and capex risk related to them. But perhaps I also wanted to close the loop again with the ratios to kind of once again stress the regime that we are looking at. And indeed, in a regime where gold to copper ratios are increasing, we would consider getting more defensives. While in a regime where copper to aluminum increases, there it's where we try to get more cyclical exposure. Although once again, with the caveat of being, we want to look also at the fundamentals of the underlying companies and again, as I mentioned, for miners, what matters is the execution capability, the capex structure, and the cost discipline.
Okay, great. Well, thank you, Andrea, for this very insightful information in regards to precious metals, industrial metals, and how to invest in them.
Thank you.
U ook bedankt, beste kijker. Wil je op de hoogte blijven van het allerlaatste beursnieuws? Abonneer je dan op ons YouTube-kanaal. Tot later.